Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking about the US utilities sector, and my guest is John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. The utilities sector is traditionally seen as an unglamorous proxy for bond markets, and they're out of fashion at a time when steep rate hikes have pumped up returns on US Treasuries. America's infrastructure, and especially its electricity grid, is also in need of vast investment, both to transition it to green energy and simply to cope with the effects of climate change. Flooding, hurricanes and other natural disasters have knocked out electricity for millions and caused an estimated $57.9 billion of damage to infrastructure this year, as soaring temperatures lead to wildfires in California and erratic storm patterns from Hawaii to Florida. This is the S&P 500 utilities sector, down 12% year to date, when the wider S&P has gained 18.2%. So, will these stocks ever come back into fashion? Let's ask John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. John, hi. Why then is this sector trailing the wider index so much?
Well, first, thanks for having me on the show, Elena. I've got to say the reason for that really is I think for the most part is as a bond proxy, the sector is particularly vulnerable. All those things that you outlined, the climate change, the fires and the problems, that's one thing. But, you need to keep the lights on. You have to keep the factories running, and the utilities are a big part of that. But from a perception of investors, the big thing is they've got an attractive dividend around 3.5% as a sector. And some have a higher dividend, some are slightly lower, depending where they are and if they're regulated or non-regulated. But the big story is here, they're considered a bond proxy. So if treasuries on the short end of the curve are yielding high 4% or over 5%, as they are, they are relatively unattractive for income investors, and they tend to trade at a discount to where they would normally be in a calmer bond market.
Given those high dividend payments, though, aren't these low valuations creating opportunities?
We'd have to think so. And I have to tell you right now, for this year, we have been rating utilities as an underperform. And gosh, we were right on that. But we have to look at next year, and what we can't help but think, in a year in which technology, communications, services, and consumer discretionary have really outperformed, with technology just shining so brightly. You tend to get a dogs of the Dow kind of effect as you cross into the new year, and people look for that which has been beat up. We can often recall it. For years, it was that way with energy, and then energy would take off and be the best performing sector. But going into next year, among the worst performers are energy and utilities, both of which yield around 3.5% as a sector. So we'd think, there's a contrarian play here, and one worth considering.
Do you think the necessary investment in clean energy, once it starts to move forward, is going to make these more attractive?
I actually do, because I think what happens is as we move towards clean energy, we would expect the utility companies will be a large part of the distribution of that energy and get involved in that. Many utilities I know in the US and abroad are involved in alternative with whether it's solar panels or wind turbines already, but we would expect more of that as we go forward. And one of our big premises is, in terms of looking forward and investing, is investing in things that are today and things that are tomorrow. And in those things that are today, those that serve as bridges for getting to tomorrow.
For investors then, how should they approach this sector?
Well, two ways. You can consider alpha or beta. Essentially, alpha is individual securities. The beta play would be using ETFs or exchange traded funds as passive indices to track the underlying index. We like to use both, what we call an alpha beta strategy. We like to say investors, like children, should learn their alpha beta. And essentially what that does, alpha, for instance, if your alpha pick on the individual stock or a basket of several individual stocks isn't good, but you're right on the sector, well, your sector helps bail you out. Of course, you could be wrong on both alpha beta, and that would be problematic. But we suggest that alpha beta approach. It gives you that broader approach to the passive index. So essentially, if you're in the right church but in the wrong pew, you've still got an advantage. On the other hand, if the index doesn't do so well, but you have individual alpha or individual stock picks that are able to work around the problems for the sector, that can help you out as well.
John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. Thanks so much for that insight. And that's our look at the US utility sector. I'm Elena Casas, and this is Reuters.